We will get started. So I want to say thank you for those who are attending. I can see the attendee list going up by the minute. So thank you, everyone, and welcome to our Transactional Liability Roundtable 2020. I wanted to introduce myself briefly. So my name's Becky Bottomley, for those who don't know me. I'm a partner in our corporate team in London, and I head up the transactional liability practice here in the UK. We are a global transaction liability team at Mayer Brown. You can see our panelists here. We're joined by members from the United States, from Germany, as well as from our tax team in London. As most of you know, we're starting to hold an annual transaction liability roundtable in London and in New York each year. We certainly held one last year, and we've had to obviously change the format for obvious reasons. So we've gone from kind of hosting an entire afternoon deep dive session to condensing that to this hour. So we'll do as deep a dive as possible within the hour, and we are unfortunately obviously having to forego the cocktails and drinks afterwards. But we still are focusing on providing what we intend to provide each time we do this, which is real insights from our work representing both insurers and buyers in the market, and really thinking about key issues that are driving coverage positions as well as market forces over the course of the last year. So I just wanted to highlight a couple of things before we get really started. There is a Q&A function as part of the session. You'll see it in the bottom right-hand corner. So please do ask Q&A or make comments throughout the session. If you can make it go to all panelists, it only goes to panelists and it doesn't go to any other attendees. We'll deal with those either throughout the session or at the end if we have time. So I just wanted to start off by explaining broadly how we're going to deal with this session. Like I said, we've had to kind of condense this down into an hour. So we're dealing with 5 key topics and running through 5 sessions. The first of those sessions is really going to be focusing on subject areas that we found particularly complex and difficult from an underwriting perspective. And again, this kind of looks at it from both sides of the table and how we really evaluate risks in those particular areas. We'll move on then to talking about a few tax issues. We then will move on to the third session, which is focusing on the US and in particular this kind of move to a more US style of underwriting. We'll start the fourth session with talking about some efficiencies that we think we can achieve in the market, and finish off with an update from Germany, from our German team. So that should take us hopefully with 5 minutes left, if all goes well, for questions and answers at the end. So we'll start off. You can go to the next slide, please. The first session. So I'm joined by Harriet Hainsworth for this session. Harriet's a senior associate in my team, and we are here going to focus, like I mentioned, on three areas really where we have over the past year found real complexities and difficulties with underwriting certain areas. I'm sure it's areas that you've come across yourselves, historically and more recently. So I'm going to hand over to Harriet, who's going to deal with the first subject area, which is data protection.
Good afternoon, everyone. So as Becky mentioned, I'm going to touch on data protection as one of the areas that we find difficult from an underwriting perspective. The GDPR came in a few years ago now, and while there was a transition period, most companies weren't really ready for it. Since the GDPR has been implemented, we found that most companies have considered it and have tried to comply, but through diligence, we see that there are often areas of non-compliance. So for most companies, full compliance with the GDPR is difficult, and it would require a large commitment in both time and resources. Many of our clients haven't prioritised full compliance at this stage, particularly smaller companies who consider that they're not holding data that's particularly sensitive. So when approaching GDPR diligence on the buy side, our clients focus on looking at the realities of the business and the potential risk. For a small company that holds employee personal data only, the risks of a few technical non-compliances might be manageable. But for a bigger financial services company, which is already regulated and which holds lots of personal data relating to retail clients, or for example, a large company which holds medical data, our clients will be taking a different view of the risk profile, as even a few technical non-compliances in those circumstances could be significant. So the key really is making sure at the outset that we and our clients understand what kind of personal data is held by a particular company, as this will inform the level of risk. As well as what information is held by the company, our clients would also look to understand how the information is used. The ICO has in the past focused on the use of data for inappropriate means. For example, you'll all remember the Cambridge Analytica scandal a couple of years ago, where the personal data of Facebook users ended up in the hands of Cambridge Analytica, who then sought to increase support for the 2016 Trump presidential election campaign. Misuse of personal data is likely to be a key focus area on that basis. So what are the risks of non-compliance with GDPR? So most companies are focused on fines and penalties, as these can be up to 2% of worldwide turnover. But in reality, the scope of enforcement is much wider than that. Individuals who are unhappy with how their personal data is being used have enhanced rights of redress under the GDPR. And the ICO also has the power to make changes to the relevant company's IT systems and processes. And these are things that people don't often focus on outside of the fines. As we've mentioned, however, the ICO's focus when considering enforcement action isn't likely to be on smaller companies who are attempting to comply, who don't hold sensitive data, as long as they're using that data properly. So in summary, compliance with the GDPR is rarely perfect, particularly for smaller companies, but it's important to understand the nature of the relevant business, what data the business uses, and how the data is used to get a real feel for the risks of non-compliance. Even if a small business is not fully GDPR compliant, we'd expect the business to have considered GDPR compliance and to have set out a roadmap or something similar of how it expects to become GDPR compliant over time. In other words, in the context of a small company, we and our clients need to be comfortable that the business has considered the risk and has the aim of achieving full compliance, even if they're not quite there yet.
Great, thanks, Harriet. I am now going to spend a few minutes talking about the next point. So next slide, please, which is focusing on regulated businesses. So we have done quite a few transactions over the course of the last year, acting on the buy side, so for the insured, on regulated businesses. And I think it's fair to say that we still find that it can be more difficult to obtain kind of interest and coverage from the underwriting market. And we had a few thoughts on why that might be, and actually I've kind of gone back and analysed where the issues have arisen over the past few deals that we have done in that sector. So when I talk about regulated business, I really mean financial services, so FCA, PRA, and equivalent in other jurisdictions. So the kind of few things that we wanted to highlight here, I guess I think the difficulties around some of the diligence we get on the regulated side is that it's quite often a mix of legal and accounting diligence. So it's quite often a mix of two advisors kind of evaluating the risks relating to the same business, which however much you try and agree scope and what each party is going to look at, it inevitably leads to the potential for gaps. And we have found, a bit of a surprise, for example, when you end up reading the accountant's report, it's meant to sit nicely alongside your legal report, and it doesn't quite do that, either because of scope or because of actually the way that the different kind of risks in the business have been evaluated. I think it's probably fair to say that this again feeds into it. There is a slightly different approach that accountants take to diligence and lawyers. Accountants do tend to, even with material red flag reports, still report on less material green non-material items, but there's never no risk items in an accountant report, it seems. And I think lawyers tend to try and be a bit more pragmatic and commercial. I appreciate I would say that, wouldn't I? And there's no accountants to defend themselves on the call right now. However, we have found that this slightly different approach does mean that you get a different view in terms of the regulatory risks on a business, which when you're giving 2 reports to an underwriting market is then completely understandably difficult for an underwriter to then really get to grips with what is important in that particular transaction. So we as a firm are looking at ways of improving that process in particular to try and kind of get underwriters comfortable and really understanding what the key risks are in reality relating to a business. I think the other issue we have here is that, as Harriet said, with the data protection side, you're never going to get a fully compliant business. So you're never going to get a business that's, 100% tick box complies with its regulatory, it complies with its regulations. It just never really happens. It's all a case of looking at and evaluating, what they do comply with. And I thought it was helpful here to just explain where our clients come from and the way they approach the risks relating to regulated businesses. The way our clients look at it when they're buying, you obviously have to distinguish between very heavily regulated businesses and businesses that are less so, albeit maybe within the scope of the FCA, for example. If you've got a business that's dealing with, grannies and granddads and their investment decisions, then you definitely have way more of a focus on compliance and certain issues relating to that, and are certainly more risk aware. We have had quite a few transactions where, albeit the target is regulated, it's in a very soft way, as it were. So you can kind of take a bit of a view on, the buyer certainly takes a bit of a view on the importance that the regulator places on that particular business. So that's the first thing. And what our clients tend to focus on, and again, I think this gets slightly missed in some of the reporting, actually, that both accountants and lawyers do, is actually focusing really on the compliance team, who they are, what their experience is, what their historic reaction has been, for example, to areas where there have been non-compliance issues, how they've responded. Looking, yes, at policies, procedures, and all the rest of it that everyone does, but actually really drilling down and looking into how they are monitored, how they are complied with, training, and really doing all of that deep dive drilling on those particular areas to really get a good idea of the compliance function in a target business like that, because that's really going to be where you get your comfort, or certainly a buyer looks at getting its comfort from the risks rather than, looking at some kind of isolated historic issues. It's really about how they've been dealt with and what they've done to improve since that point. And then I think the final point I just wanted to make here is, again, I often find that when you're looking, again, which I think also gets missed in a lot of the diligence reports that you actually see, is with businesses like this that actually have a compliance function, they tend to kind of percolate that whole philosophy throughout the rest of their organisation. So you tend to see, for example, maybe a slightly better HR function, or other areas where the kind of requirement to comply is assessed over the entire business. So you often get that percolating through, which again gives certainly I've had conversations with insureds where that has gotten them quite comfortable with the relative risks relating to that business. So moving on to the final point now, I'll hand back over to Harriet, who is going to talk for a few minutes about historic acquisitions. So next slide, please.
Thanks, Becky. So as the final item just to discuss in this session, I'm just going to touch quickly on historical acquisitions. So most PE firms who are big users of W&I products have a clear strategy at the outset of an acquisition that they'll buy a target, carry out a series of bolt-on acquisitions to grow the group and create synergies. So then when it comes to selling the target group, historic acquisitions are a key focus, both for diligence on the buy side and for W&I insurers. We find this is one of the areas where clients are surprised at their coverage and where the lawyers have to do a detailed gap analysis, as insurers are historically less comfortable covering historic acquisitions, which is why we just thought it would be helpful to flag this item today. So in terms of diligence, we'd usually expect the buyer's lawyers to review all of the historic SPAs, where there are any outstanding rights or obligations. Usually the key focus areas are whether there is any deferred consideration which remains due for payment by the buyer, and whether there are any outstanding warranty or indemnity claims in relation to the business which has been acquired. For more recent acquisitions, we'd also expect the buyer's advisors to have reviewed the diligence reports and disclosure letters for the original deals, and to have given a view on the scope and key issues that were flagged on those acquisitions. We'd also expect the target business that was the subject of the bolt-ons to be incorporated generally into the scope of the diligence exercise of the buyer. So in other words, while the old reports should be reviewed, they shouldn't be relied on without independent diligence by the buy side, and that's the important point. Historic acquisitions should have had the tyres kicked appropriately if they want to justify insurers providing cover. So in terms of the risk profile, more recent acquisitions are obviously more problematic from a diligence and coverage perspective, given that there are more likely to be unknowns. Any acquisitions that are, say, over a year old or that have come through the audit process already are likely to be less risky, just in terms of the likelihood of unknown items coming to light. So we often find a bit of confusion at MBI stage in relation to historic acquisitions, as it's usually an area of heightened underwriting. And it is helpful for expectations to be clearly set out at MBI stage to avoid last-minute coverage issues, which was the point that we wanted to flag today.
Great, thanks, Harriet. Okay, so that kind of finishes up the first session on underwriting complexities. We're now going to move on to talk about tax. So I'm going to hand over to Kitty Swanson. Kitty is counsel in our tax team in London, and she's just going to go through a few interesting tax points that have come up in her practice over the course of the last year or so. Over to you, Kitty. Next slide, please.
Thanks very much, Becky. Good afternoon, everyone. I'm going to start by discussing a few issues we see frequently around the tax due diligence process and the level of disclosure in the related reports. And then I'll finish up by spending a bit of time talking about tax exclusions. So one of the key risks from a tax perspective is that the scope of the tax DD exercise often falls short of what an uninsured buyer or an underwriter would really want to see. So I'll give you a few examples of that. These are issues that we regularly see lead to discussions around the scope of coverage. So firstly, the majority of DD reports we see for tax still only cover 2 or 3 completed accounting periods, even though in the absence of carelessness or fraud, most taxes remain open to HMRC investigation for 4 years from the end of the accounting period. The risk here speaks for itself, really. Without due diligence into those earlier periods, there's just no way to know what the target may have done, or in fact not done, during those periods. Although we do sometimes see underwriters get comfortable with this, it does depend on the findings for later periods. If the target is generally pretty clean from a tax compliance perspective, and there haven't been any one-off transactions such as restructuring in those earlier periods, it's generally much easier for underwriters to get comfortable than if the target has a poor compliance history or if it's undertaken high-risk activities. Similarly, we often see an information gap for the most recent periods, as corporation tax filing deadline, which is 1 year after the end of the accounting period, means that in practice, very little information may be available up to 2 years prior to the completion date, depending on when a transaction occurs. This is actually particularly acute this year due to the extension of normal accounting filing dates, as corporation tax figures flow from the accounts. So at this point, even though we're in November 2020, many businesses still don't have clarity on their FY19 tax position. To a degree, obviously, this problem is unavoidable, but in practice, we see that businesses that have been well prepared for sale and have taken the time to provide as much information as possible in these later periods tend to find themselves in a better underwriting position, and the process is generally more straightforward. The third common gap concerns jurisdictional scope. We frequently see jurisdictions excluded from due diligence on the basis that they weren't considered material to the business. Unfortunately, just because activities in the country might be considered immaterial in the context of a wider business, doesn't necessarily mean there couldn't be material tax liabilities in that country. Whether in practice underwriters can get comfortable with this generally comes down to how the buyer has assessed materiality and how this interacts with the de minimis threshold and any other limitations under the policy, and the conclusions on tax compliance standards for those countries that have been subject to due diligence. In our experience, if compliance is generally good, then underwriters are more likely to be willing to take a view on this and might cover minority jurisdictions, even in the absence of local due diligence. And finally, for this first section, just a brief mention of historic acquisitions to follow on from what Harriet was just saying. From a tax perspective, I absolutely agree that if the scope of due diligence is appropriate and covers all members of the target group, whether required or not, then it should be much easier for underwriters to get comfortable with the fact these are taking place. And where it gets difficult is where we see cases where acquired subsidiaries have been excluded from tax DD simply because buyer is planning to rely on the previous due diligence, and that's much more difficult from an underwriting perspective. So these are all areas where brokers can actually really help the underwriting process by discussing the scope of due diligence with buyers as soon as they become aware of transactions, and just making sure that buyers understand the potential impact of any of these gaps, so that hopefully there won't be any surprises further through the underwriting process. Another key challenge with underwriting tax risk continues to be the level of disclosure in tax due diligence, which, to be honest, varies enormously and can cause problems at either end of the spectrum. So at one end of the spectrum, we see very detailed tax due diligence reports that mention lots and lots of things, many for the sake of completeness, and conclude that they're low risk. And I should note that a no risk classification doesn't really exist for tax. And where this happens, buyers generally expect that those low risk items would be covered on the basis that they're not disclosing a known issue. However, it isn't always clear from the policy terms that that's the case. And we do see differing standards across the market on what insurers consider to be a known or identified issue. And what we're seeing is an increase in requests for so-called affirmative cover on points that are of particular interest to insureds. For example, for a corporate real estate transaction, that might be trading versus investment status. So that buyers can get greater certainty on what will and will not be within scope of the policy. But where we see varying standards between insurers on how amenable they are to doing this and what level of diligence they expect to see in order to be able to do that. At the other end of the spectrum, we see some due diligence providers trying to get around this problem by producing very short red flag reports so that low risk or low value items are just not mentioned at all. This obviously creates a completely different set of problems because it's actually extremely difficult then for underwriters and their advisors to assess the extent and depth of the DD exercise that's been done or what the potential exposures might be. For example, silence on, say, VAT might mean that whoever was producing the report did a thorough exercise and didn't find anything, or it might simply mean that they asked management when there were any problems, management said there weren't. It's impossible to tell from the report. So I think what we're finding is it's important for insurers to have a clear and consistent view on how they approach these issues, so that both buyer and underwriter understand what is intended to be within scope of the policy and what may be excluded. This, again, is an area where brokers can really help the process by discussing expectations with buyers at an early stage to ensure that DD reports are fit for purpose. Moving on then, I'm going to spend a few minutes talking about the so-called standard tax exclusions, as we've had a number of cases recently where policyholders challenge the scope of these. And for all they're considered standards, there does seem to be a little bit of flexibility in the market on how these are interpreted. So I think everyone who's involved in W&I insurance knows that the standard tax exclusions are transfer pricing, secondary liabilities, and loss of tax assets. But what do these mean and how far do they go? Looking first at transfer pricing, the transfer pricing rules aim to tax transactions between connected parties as if they've taken place on arm's length terms. This has typically been an exclusion for W&I because it's very difficult to diligence and is very subjective. Transfer pricing rules apply to all connected party transactions, but we see challenges that are particularly common in the context of intergroup debt arrangements, where the effect of a transfer pricing adjustment is that interest deductions can be denied, and that increases taxable profits and therefore corporation tax. So your typical transfer pricing exclusion W&I policy normally captures liabilities under the UK's transfer pricing rules or any overseas equivalents, which is what we would expect. However, we have seen cases where this has been extended by insurers to restrictions on interest deductibility more generally, even where that has not been identified as a particular risk factor in DD, which obviously is a concern for potential insureds. And then at the other end of the spectrum, we've seen cases where underwriters don't actually include a transfer pricing exclusion at all, usually for smaller domestic targets where the risk of a transfer pricing assessment is lower, but competition in the market does seem to be driving some flexibility on this particular exclusion. Turning to secondary tax liabilities, these are tax liabilities that are the primary liability of a non-target entity, but which can be assessed on a target entity post-completion due to the pre-completion relationship between the parties. This is a particular issue where a target is acquired out of a wider group, or even from a single company. Although a covenant for secondary tax liabilities makes a lot of sense when given by the seller, in a non-insured transaction, since it relates to seller or retained group liabilities. Secondary tax liabilities have traditionally been excluded from W&I cover because covering these is essentially underwriting the seller's or the retained group's tax position, which is obviously outside of scope, it's out of the target's control, and it won't have been subject to DD. However, although this general principle is well understood, we see frequent requests from insurers to clarify the scope of this exclusion. Most commonly, concerns relate to PAYE employment tax liabilities and withholding tax on interest payments. In both cases, the payments relate to tax liabilities of someone other than the company, the employee in the case of PAYE income tax and national insurance, or the recipient of the interest in the case of withholding tax. But crucially, the primary obligation to account for those taxes lies with the employer, company, or the payer of the interest. So they're not true secondary liabilities. Our experience is that when these issues come up, underwriters generally confirm that they don't intend to exclude these sorts of liabilities and would normally consider employment taxes and withholding tax to be within the scope of their policies, subject, of course, to any specific exclusions or transaction related. But we do see requests for clarity on this very frequently. Similar issues also arise in respect of targets that have previously been part of the VAT group with the seller or other retained group companies due to joint and several liability of VAT group members. Position on this point is less clear. So joint and several liabilities arguably a primary liability, but can pick up responsibilities that other companies should have picked up. And what we're generally seeing is that where this is in point, underwriters are seeking to clarify this by way of specific exclusions where relevant. So finally, the loss of tax assets exclusion. What is a tax asset for these purposes? We see very differing opinions on the breadth of this exclusion, so I think it's worth exploring this briefly. I think it's probably fair to say that there are four main categories of tax assets or reliefs. One, repayments which the target expects to receive. For example, if quarterly instalments of corporation tax have exceeded the actual tax due at year end. Two, credits which the target expects to receive to reduce its tax bill. For example, research and development expenditure credits. Three, carried forward losses which the target expects to be able to use to reduce future tax liabilities. And four, deductions which the target has already claimed, for example, for interest or other expenses, to reduce its taxable profits and thus its tax liability pre-completion periods. It seems to be generally accepted that the loss of tax assets exclusion would catch the first three categories, which is consistent with the fact that non-availability of any of these items doesn't increase pre-completion tax, and therefore arguably doesn't give rise to a loss that ought to be covered by the policy. There are also things that buyers often don't actually give any value for because there are certain risks in the availability of those assets post-completion, particularly where there's been a change in ownership, which of course is always in point in these situations. However, the treatment of the fourth category, deductions for expenses pre-completion, has been a live issue on several transactions we've seen recently. The question being, is the non-availability of these deductions excluded from cover, even where it gives rise to actual pre-completion tax? What we're seeing is that an increasing number of policies specify that actual pre-completion tax arising as a result of the loss of a relief is not caught by the exclusion, although it may of course still be caught by specific exclusions, for example if concerns around interest deductibility have been identified. But some policies still do not specify this as a matter of course, and that leaves insureds asking questions about this point. I'll now hand back to Becky to introduce our US colleagues in the next section.
Great, thanks Kitty. So moving on to the next slide, I'm going to introduce two partners from our US transaction liability team. So I'm joined by Bill Casera and Joe Castelluccio, who lead our practice out there. Joe and Bill are really going to focus on this move that we've seen in the European market to a more US style approach to underwriting. I think we've all been, it's pretty common in the market now that various enhancements, so-called US style enhancements, are offered or provided at MBI stage, which is pretty typical now to try and obtain that kind of more advantageous US type cover. What we're focusing on here is some requests, particularly from US buyers, to actually have a more US style approach to underwriting, which is more process driven. So Bill and Joe are going to take us through that, and I'll hand over to those now.
Thanks, Becky, and thanks to all of you for joining us today. Next slide, please. Okay, so while the term US style approach may conjure all types of images, like the one many of you are probably seeing on your screen right now, in the context of transactional liability insurance, there are a few key characteristics that are different from a typical UK style approach, as Becky was just mentioning. Next slide, please. At the end of the day, though, the goal is the same: to appropriately diligence and manage the risk for the underwriter, while at the same time providing the best possible coverage for the deal. So to illustrate these, we thought we'd walk through a couple of steps in a typical US underwriting process, albeit at a very high level. Now, Bill is going to pick up the discussion from here in the quote or NBIL phase of the process.
Great. Thanks, Joe. Next slide, please. Good afternoon to our friends in UK and Europe, and good morning to our friends in the United States. I see some of you guys on the attendee list, so thanks very much for joining. As Joe suggested, I'm going to briefly walk through how the US market works its magic during the quote or the NBIL phase, which we think is interesting as you think about, a quote US style deal and US style enhancements. So of course, at the first step, the insured retains a broker, and the broker then canvasses the market for quotes. This quote process is done on relatively limited information in the United States, really 3 documents. One, a purchase agreement, although I'll note this is often a relatively early draft of a purchase agreement, sometime even the seller's bid draft, and so long before the reps that will ultimately be insured are negotiated, but that's what markets have to quote off of. Secondly, some kind of an offering memorandum or information about the target business. And then thirdly, typically some sort of financial statements with respect to the target business. Importantly, in the United States at the quote phase, due diligence and or disclosure schedules are rarely, if ever, delivered as part of the quoting process, which is of course a limitation with respect to the information that's available. So this, of course, raises some challenges. On the one hand, given the number of brokers, the number of markets in the United States these days, the broker's probably going out to at least 5 markets for a quote, and maybe substantially more than that. So insurers certainly have an incentive to keep the number of exclusions or proposed exclusions as few as possible at the quote stage in order to win the business, candidly. They want to be as competitive possible, and they realize that they're competing against many other markets. But on the other hand, in the United States, underwriters are generally pretty reluctant to add exclusions down the road once they've been chosen and once they've worked through the underwriting process. It seems as being uncommercial or difficult, and they're worried that may give them a bad reputation with this insured, or frankly, more importantly, with the broker, who of course is a big source of business for them. So it's certainly a catch-22 for U.S. markets at the quote stage. This balance between not wanting to put a lot of exclusions into the quote in order to frankly win, and then not being able to add a bunch down the road. So how do U.S. insurers tend to approach this at the quote stage? For one, thinking about the industry in the segment that the target's in, the risks, have they seen that industry before? Has it given rise to a bunch of claims? Second, in the U.S., oftentimes insurers will add to their NBIL a list of heightened concerns, things that give them the kind of the moral high ground to explore further in due diligence, and that might be a thing to latch onto for an exclusion down the road. That often is based on materiality. For instance, you wouldn't necessarily flag a heightened concern for environmental in a software deal. Third, underwriters sometimes bring in advisors to ask some questions, financial or legal advisors at the quote stage, although that's relatively uncommon. U.S. markets are seeing lots and lots of quotes, multiple quotes a day, frankly. And so rarely are they able to bring in advisors, but they can. Another technique is to ask the broker to try to get a sense of the due diligence that's going to be coming. Will it be, a quote standard range of diligence, phase 1 reports, Q of E's, that kind of thing, or it will be done in-house or less than a full report? And then lastly, what's the nature of the buyer? Is it a financial buyer? Is it a strategic buyer? Are they doing the diligence in-house? Does the buyer have a history of making claims? All of these things are considered by U.S. underwriters at the quote stage, in light of this dynamic about this balance between not being able to put a lot of exclusions in the quote and also not being able to put them in later in the process. The fact of the matter is, what happens more often than not in the United States is, U.S. underwriters kind of wing it a little bit. They look at the deal, they get comfortable, they put a quote in, and if they win the quote, then they'll underwrite and figure it out. There's a very high volume of deals in the United States these days, and it makes it very difficult, if not impossible, to spend a lot of time on any one deal at the quote stage. That's just reality of the market these days. So that's candidly how lots of U.S. underwriters approach, the quote in this conundrum about the balance between exclusions before and after. So that's a little bit about the quoting process. I'll turn it over to Joe to talk about the actual underwriting process itself.
Cool. Thanks, Bill. Next slide, please. Okay, so talking next about the diligence or underwriting phase, one way to describe a U.S. style underwriting approach is that the underwriters diligence the diligence. Now, how does that look? Well, underwriters will receive the full diligence package that has been prepared by the buyer and its advisors. In a typical deal with a PE sponsor as buyer, this means a legal due diligence memo, a quality of earnings or similar financial DD report, as well as a tax DD report. And in addition, this may also include reports from other subject matter experts or advisors, including IT, employee benefits, or environmental, depending on the nature of the target and the industry. Now, on the other hand, if you have a strategic buyer, the diligence package can vary a lot more, as a lot of the diligence is often performed in-house by the buyer's own subject matter experts. Now, in our experience, the diligence can be just as robust as if performed by outside advisors, but the reports themselves may vary more in detail and polish, to be perfectly honest. Sometimes they can take the form of simply emails from internal experts to their deal team instead of the multi-page formal reports that you might see from outside advisors. Now, one thing that you won't see in a typical US style process is written responses to underwriting questions. I know this is a staple of the UK process, but one of the this characteristic goes hand in hand with another challenge in a US style deal, and that is the very short time frame that underwriters are often given with the DD package. Now, in reality, the DD items often come in piecemeal fashion, and a lot of times shortly before the underwriting call. Now, I know all of this sounds less than ideal, but obviously we find ways to deal with it, and there are a few ways that we do this. First, questions are typically handled in an underwriting call, and while the responses that you get to your questions aren't written, there is typically an opportunity to ask very detailed questions of the buyer and its advisors. Now, we as Underwriters Council often help prepare tailored agendas for the underwriting calls that look very similar to the slate of questions you'd prepare for written responses. And while it is more of a hassle to produce notes on those calls, your notes can serve, obviously, a similar function as the written responses can. Second, the underwriter relies more heavily on the buyer's due diligence, as opposed to reviewing certain matters de novo or on its own. A big part of the underwriter's diligence is vetting the reviews and reports prepared by the buyer's internal and external teams. And not to sound like an advertisement, but this is where experienced Underwriters Counsel is particularly useful as well. Counsel can identify and often has specialists that can comment on areas of specific concern and potential risk. A few that we see often that give underwriters headaches are things like trade controls, government contracts, and privacy, among others. So I want to wrap up this part of the section with one other practice point. In reality, U.S. underwriters often have a hard time adding exclusions at this stage. Bill mentioned some of the market pressures earlier. This is even when diligence points to potential issues. I already mentioned time pressure. There are reputational issues, market dynamics, all things point towards this challenge, frankly, for underwriters. So one of the things we spend the most amount of time on in the diligence phase is parsing issues that may be uncovered in the diligence to understand the probability and the magnitude of the potential risk so that the underwriter can cover as much as possible with as few exclusions as possible. Now, I know there are some brokers on the line, so just to be clear, that doesn't mean that everything gets covered no matter what. We do try to be pragmatic and reasonable and hopefully everybody else is as well. Now, to wrap up the view from the colonies, Bill is going to touch on a few key terms that are common in U.S. deals that will impact the scope of coverage.
Terrific. Thanks, Joe. And next slide, please. So very quickly, just bringing the U.S. portion in for a landing. When we talk about U.S. style coverage, I thought I would highlight a couple cornerstones of U.S. style coverage these days. These are things that have really evolved over the years that many of us have been doing this to more or less be the standard in the United States that you see in virtually every deal. There's obviously exceptions, but these are to the point of being what I would say, quote unquote, market in the US. So certainly if somebody in the UK or Europe gets a call and say, I want US style coverage, these are things that would be high on the list. First is the materiality scrape. That is quite common in virtually every deal. Even transactions that are non-recourse or that the purchase agreement itself does not include a scrape, you often would see a synthetic scrape in the policy. So this is quite common. Second, those of us who have been doing this a while know that years ago there was quite a debate and fight over the definition of losses. What do you do with consequentials? How do you handle that? The market took a very pragmatic approach and more or less gave up. And so the standard these days is silence as to losses. More or less, we'll figure it out at the time based on the claim that's made in the state law that governs. Second, and this is a pretty key variation from the UK style and approach, is typically in the United States, there's relatively limited revisions to the reps that are being made in the purchase agreement. There's some exceptions to that, and I've seen some, quite recently where the NBILs will call out 3, 4, 5 changes to the reps that would be put on for purposes of coverage. But generally, it's a handful, if any, and there's certainly not a warranty spreadsheet or anything like that, like you would see in the UK. So that's a pretty big difference. And then lastly, it's been standard since the very beginning in the US that every policy will have an actual knowledge exclusion. In other words, what the buyer's knowledge folks actually know about will not be covered. And this, of course, picks up things that are disclosed, because that are things that they will obviously know about. So those are 4 really key terms of U.S. coverage that if you get asked about U.S. style, I bet you those things are on the list. So very quick overview. Joe and I, of course, would be happy to chat with any of you about U.S. style issues, what we're seeing in the United States. You know where to find us. Feel free to reach out. And Becky, back over to you.
Great, thank you both. So conscious of time, I think we're just going to move on now rapidly to our next session, mini session. So next slide, please. So I'm just going to talk for a few minutes on a couple of points really that go to really efficiencies of in the market and making the market more efficient. And I have had quite a few conversations with a few brokers and the like over the course of the past few weeks and months on these very subjects. So this is actually where it's quite a shame that we're not in the same room, because I'd love to hear views on these points in particular. So the first point I just wanted to run through is warranty comments at NBI stage. So I do feel quite strongly about this, but I kind of understand from a historically buyer's perspective, broker perspective, it's helpful to really see what the warranty comments look like at NBI stage, which helps you kind of assess the different offers that the various insurers have made and helps you evaluate that that coverage position more accurately, I guess. And obviously, from the underwriter's perspective, you're being asked here to review detailed comments on warranties in very short order for a deal that you might not even get. So it's quite time consuming. I just wanted to give a view from where I think the market's kind of evolved more recently, and particularly how we approach it when we're advising buyers and when we are actually looking at these broker reports and reviewing NBIs ourselves. So, I mean, I almost don't want to say this, but I have to say that I don't place a huge amount of value on warranty comments when I am looking at NBIs I guess you can see quite clearly whether there's a lot or few. So that's the basic comparison. But I think, again, candidly, when you're assessing coverage position, what you're really focusing on is always exclusions in areas of heightened underwriting. I think being able as deal lawyers to look at including the way that the warranties are actually commented and marked up in the various MBIs and reports, and trying to evaluate those and compare them is just too difficult. And it's too difficult, particularly at that stage of the transaction. So I don't place a huge amount of value on those warranty comments. And I think particularly because you're looking at a set that are kind of potentially nowhere near where you're going to end up at the end of the transaction. So it's kind of not really focusing on, I think, where you're really looking at the coverage position. What I have spoken to some brokers about this in the past, but I think when I'm looking at coverage, the odd wording of a warranty here or there is probably not going to fundamentally change what your position is. I really want to focus in on heightened areas of underwriting and exclusions, and that is the basis on which I talk to my insured clients, the buyers, about that. The whole MBI comparison. Very rarely do we talk about warranty comments in particular, and I think the other thing that I find difficult about the kind of warranty spreadsheet at a very early stage is you kind of get held to a certain position when actually the underwriters haven't had the chance or the opportunity to look at DD. They don't really know the business, so you haven't gotten to the point where you can evaluate whether you are more comfortable or less comfortable with the business, which actually might impact the way that you mark up warranties. But there's not often departures from terms at MBI stage. So I am kind of approaching this in a slightly different way. I prefer the focus to be on, really, to be honest, the broker's view on the particular underwriter, the reliance on the broker to get to a reasonable and justifiable position when it comes to warranty comments in particular. And at the end of the day, they are reducing, as we all know, in this kind of, moving on from what Joe and Bill said, moving on to more US style, the number of warranty comments are getting smaller, but there are some that we just know are going to be there. So you can almost have, a section in the MBI that talks about anything in any warranty needs to be, notice needs to be in writing, fact matters, circumstance needs to be qualified by witness, that sort of stuff. So I guess what I'm trying to say is I think one of it's certainly inefficiencies that I see in the market at the minute is this kind of time intense pressure to get warranty markups that frankly I really don't know add much value, certainly when we are looking at MBIs. So again, it's a shame that there's no one in the room to shout at me or to agree with me in the room, but please do put something on the Q&A if you've got a view on that point. I think the next point I want to just briefly touch on before we move over to Germany is, again, kind of moving on to really trying to understand as far as reasonably possible at the MBI stage what your coverage position is trying to really focus on the areas of heightened underwriting and what's going to need to be done in order to get those elements, or at least certain parts of that covered. What you'll see from a deal lawyer's perspective is that we go through the broker report and the MBI in quite a lot of detail, particularly on obviously the premium numbers and the exclusions, heightened areas of underwriting. We go through those parts in quite a lot of detail with the client at that stage, and we kind of understand it, choose an insurer and then move on. And then you get to the underwriting. You don't really talk to your client again about coverage until you get your policy with your terms there. And that can often be a couple of weeks, and it can often be 2 days before signing. So I have quite consistently had conversations with clients where it does come as maybe a little bit more of a surprise than it should be, that certain areas are excluded from coverage. And I think this is where the areas of heightened underwriting could do with a bit more prodding, again, at MBI stage, as much as reasonably possible without any DD, of course, but to really focus in on, okay, what are you expecting to see in DD, and how clearly you're talking about in order to provide some decent coverage here. And, even getting on the phone, frankly, with deal lawyers at that stage to talk those kind of things through, because it is one of the more difficult areas that we as deal lawyers have to try and kind of manage in terms of client expectations. So they are, again, I would love to hear some views on this, so please do use the Q&A function if you've got any views on those couple of elements there. But I'm now going to move on to the final session, which is I'm going to hand over to Jan Streh, who's a counsel in our German office, and he's going to give a few updates from the German market, and then we'll try and answer some questions after that. Over to you, Jan.
Thanks, Becky, and good afternoon, anyone. Yes, I'm trying to use the remaining time most efficiently, and we'll briefly touch the market development as such in Germany, and then also pick up a few policy-related items we have here. So market-wise, I guess it's the same as anywhere else in the world right now. The German W&I market, the M&A market, has been significantly hit by the COVID-19 pandemic. Most of the market were down just at the beginning of the first half of the year, March to June. But since then, at least in Germany, we've seen a significant increase in business, in particular in September and October. And it now needs to be seen how that will develop going forward. Germany has been back on a partial lockdown since beginning of November. At least our M&A business, we have seen no indication that that is impacted by this. But we've heard from the market, from brokers, that at least they have experienced a slightly less new business coming in. So yeah, it needs to be seen how that will develop. But overall, I guess the markets in Germany, but probably most likely anywhere else in the world, are much more stable right now than they were back half a year ago. So we are quite confident that the M&A transaction level, as well as the WI market level, will remain comparatively high as it's been in September and October. Generally for Germany, I guess it's worth pointing out that it's still a very attractive market for W&I. It's become a very popular tool, and both for strategic investors, for private equity investors, financial investors. And we still, even though the market is already quite competitive, we still see new insurers coming in, and we also see insurers who are already in the market increasing their team sizes to add up. There, in particular, in the area of tax, that is one focus area here, at least in Germany. Policy-wise, I guess it's kind of the same trends in Germany as we're seeing them in the rest of Europe. The impact of COVID-19 on policies has been relatively limited. Because in the beginning, I think general exclusions were discussed, but insurers quickly, particularly in Germany, moved to, well, if at all, to specific exclusions. Really focus on this in the underwriting process, and most of the deals in the market right now we see are in industries anywhere that are not really affected by COVID-19. So that is, overall not that much of an issue, COVID-19. Where COVID-19 had some impact was that due to less business being in the market, the already existing competition in Germany has further intensified. So, and premiums already being at a low level in Germany, probably also as elsewhere in Europe, we see that the competition increasingly focuses on coverage. So, in particular, specific exclusion, but also general exclusions, which were kind of not negotiable in the past, are now insurers are now open to discuss these, and appear to be quite flexible. That also applies to an increasing level of blank spot coverage we see here, something we hadn't seen to that extent in the past, but that is also more common if the deal specifics obviously allow for that. Not yet effective is something that has been discussed quite often in the past. So that's a set of full synthetic warranties is obviously also currently being discussed in Germany, whether we will see a wave of that coming in, the current level still being low. So far, the amount of distressed M&A is still low in Germany. So mainly due to the fact that, the German government had changed the insolvency laws, kind of suspending the relevant provisions until the end of the year, and also due to public aid being available. But so there's some likelihood that this will become an issue then early next year, even though at this stage, full synthetic warranties do not play a major role. So in contrast to full synthetic warranties, we see and have seen individual synthetic enhancements, same as in all other jurisdictions. They play a major role, and at least what we see, that the buyers who were previously very much focused, in particular in Germany, on price, they now see the advantage. They become more educated. They now see the advantage of accepting and buying these additional enhancements, and that's been a major tool for the insurers. So maybe last point here, US policy enhancement, as we've heard from our US colleagues, are still at a low level right now. In Germany, we see how that will develop in due course. We have seen them, in particular, if there was a heavy US involvement in such cases where you have a US purchaser, SPA reflecting more US and European standards. So that's been an area where we have some connection to the US procedures. So that was now very, very quick. The invitation to anyone to get in touch and to discuss any issues, obviously separately, but I'll return back to Becky. Thank you.
Great, thank you. So I think we've got time for one question. So then we can sign off. So I've got a question actually that's coming from our US colleagues. So I'll read it out here. So as someone who's been involved supporting both European and US underwriting processes, which aspects of the US process do you feel are most tangible and valuable for the insureds, understanding that deal teams are often busy with many other work streams? So I'll hand that over to Joe and/or Bill.
You want to take that, Joe?
Sure. And happy to have you tell me if you look at it differently, Bill. I think, look, the underwriting process is clearly a bit more truncated in the US, or in a US style approach. From the insured standpoint, from the buyer standpoint, that probably leans a little bit in their favor, right? It's less opportunity for issues to be uncovered, although diligence is still, in our view, just as robust by the buyer. They don't really want any unnecessary surprises, and we haven't seen really in any meaningful way the type of moral hazard you might conjure up, thinking, well, if the buyer knows the insurer is going to cover it anyway, we'll just not do the diligences in as much detail and kind of let the insurer bear that unknown risk. That's theoretically possible, but it's not something we see a ton of. So with that said, what's most valuable for the insured, for the buyer? The underwriting call is particularly important. When we're on the buy side, when we're representing not the insurers, but the buyers in M&A deals, we spend a lot of time helping our clients, especially those that haven't gotten this type of insurance before, prepare for the call so it can be efficient, have the right people on the team, and have those people be able to answer the questions in a way that the underwriters need to hear and want to hear. So since there's not a ton of time in these, usually having the right information conveyed on that underwriting call is really important to having this streamlined process work well, and to not have any 11th hour, frankly, timing delays on the insurer side, which can throw a monkey wrench into what are already aggressive deal timelines. But Bill, let me know, what do you think about that?
Yeah, I think that's spot on. I'll just very quickly make one more point, which I've made that in the past. But just on the point about the underwriting call in the United States, and I do think this is a bit of an advertisement for this product that is not used as much. On many occasions when I represent buyer insureds, that underwriting call process highlights certain things that perhaps we on the due diligence side hadn't fully thought about. So it's really an interesting check and balance, and candidly a useful check and balance through the buyer's due diligence process. So there's kind of a two-way street in terms of value. And that's something that I think we as an industry should promote more in the US because of the many other benefits of using transactional insurance. You know, that's certainly one of them that, you know, it allows as an interesting check and balance on your due diligence. So I made that point before, I'll make it again because I think it's worth making twice.
That's great. Thank you very much both, and thank you for that question as well. So I think we'll wrap it up there. It's just gone 5 over here in the UK. So just a quick one to say thank you very much, all of you, for attending. We really do appreciate it. Sorry we can't have a drink. We'll do so next time round. I really do hope so. And just a final thought that we've got a claims panel in a similar format that we're going to be hosting at some point early next year. So please do keep an eye out for that. But thank you very much again, and have a lovely evening.